Okay, now that we understand how to record accounts receivable and the fact that revenue is also recorded when we record accounts receivable, we have to be able to deal with situations where our customers don't pay. So we've recorded revenues, but our customers aren't paying us. Well, we can't just leave that revenue as reported on our income statement, increasing our profit, and the company sure doesn't want to have it as included in taxable income and pay tax on it. So what we're going to do in study objective 3 is learn how to record an expense called bad debt expense. This expense will offset any revenue that we've recorded for amounts that we never collect. All right, there's a couple different methods that this study objective is going to get at. One is good, one is bad. The direct write-off method is a method that is not accepted under generally accepted accounting principles. It only exists really because this is the method that companies have to use for determining tax deductions for bad debt expense. But for our purposes, this is the method that is not applicable. It's not allowed to be used according to the rules under GAAP. Here, you'd record this bad debt expense whenever you decide that a certain customer isn't going to pay, and you write off their account. This is bad matching. Essentially, you could have revenue from this M.E. Doran in 2010, and then you don't know that they're going to not pay you until 2011, and that year you record the expense. That is a mismatching of revenue and expenses. It creates unnecessary fluctuations from year to year in profit. So instead, what we're going to do in this study objective and in this class, and really all throughout financial accounting concepts, is use this allowance method for uncollectible accounts. Basically, we're estimating what's not going to be paid to us because we have history on our side, and we can approximate at any given point in time how much of our current accounts receivable balance won't be paid. We don't know who isn't going to pay us, which customers, but we know a certain portion isn't going to be paid. And so what we're going to do is come up with a way to reduce our asset of accounts receivable to this cash realizable or net realizable value. That is, let's put an accounts receivable amount on the balance sheet that just shows what we expect to collect, not what we're owed in total. Okay, and this is a much better matching concept. We're going to record expenses, bad debt expense, in the same period that we record revenue by estimating what percentage of that revenue isn't going to be collected. So to record the estimate, a company will debit the account bad debt expense. That increases that expense to offset any revenue. But you can't credit accounts receivable because you don't know who's not going to pay you at the point in time when you're recording the expense. So instead, we're making up this new account, allowance for doubtful accounts, otherwise known as ADA. And this is a contra asset account, and it gets reported on the balance sheet right under accounts receivable as a negative amount. So it'll reduce what we show as AR to a cash realizable value. You can see in this example, there were credit sales in 2010, 200,000 remain uncollected. The manager estimates that 12,000 of these will be uncollectible. That means that $12,000 needs to be recorded as bad debt expense, and that will offset this credit sales amount in 2010 and the corresponding accounts receivable that remain unpaid down to a recognizable amount or a cash realizable amount. You can see how it would look in a balance sheet, a partial balance sheet of current assets here. There's the AR of 200,000. Here's the negative ADA estimate. So this is what the company actually expects to collect. This is the net realizable or cash realizable value of accounts receivable. Okay, I'm going to get into some other things we have to handle regarding this method and entries in the next video.